This is Sony Regis reporting from the Philippines. Since the global financial crisis, China has continuously been striving towards its continuous growth. Sustaining China's economy and creating better numbers for its growth rate is now the main course of the Chinese government. There is no better way than up for China, based on the sheer numbers that they have to deliver to the economy. Since the beginning of 2008, China was the first economy to try and sustain its growth rate. Critics would say that this is because China has continued using an old and traditional economic model where they base their needs in investment for short-run economic sustenance and base their long-run goals to the exports of their country. However, this spiral upward movement of China's economy reached a problematic stage earlier this June 2012, when its growth rate slows to 7.6% from an 8.1% in the first quarter of 2012. Critics would say that this can be attributed fully to the expected consumer inflation problem and on an import growth. If we would analyze these problems, this would mean that the Chinese economy's old and traditional model of more exports and more investments is starting to have a trickle-down effect to its consumers when the exports are lower than the imports. When it comes to Chinese investment, the economic model on producer price deflation has created a more problematic investor system to China than it could have helped starting in June 2012. However, China's economic leaders are expecting an increase in the numbers in the next quarter of 2012. Of course, the downside risks remain, and the old model of short-run and long-run methods will still be applied, but the problem is whether or not China can sustain their needs in the medium run where its numbers need to go up and expected economic downfall would start to rise again. Tony Regis, Philippines.